Precious metals. Flash crash, January 30th, 2026. On January 30th, 2026, gold and silver suffered a sudden flash crash after weeks of parabolic gains. Spot gold plunged as much as 8% intraday, from a $595 high to around $4,941, and silver collapsed roughly 17%, from $120 to $95 within minutes. This wiped out on the order of $4 trillion in market value, with analysts noting it was the steepest one-day decline for both metals since the 2013 crash. The break came just a day after record highs: $5,594.82 gold, $120.45 silver. Although prices later rebounded somewhat, gold around $5,200, silver near $100 by day's end. The dramatic swing underscored extreme volatility. Causes: analysts attribute the crash to a mix of macro news and forced liquidations. Headlines that Donald Trump would name former Fed Governor Kevin Warsh as Fed chair sent the dollar higher and scared investors out of easy money bets.
Gold and silver is at record levels, and there's no signs of it stopping anytime soon. Protect your savings with precious metals. Get more information on obtaining physical gold and silver or starting a precious metals IRA from our top provider, Birch Gold Group. Get a guide and more information right now by going to the link below the video or by going to goldforthefuture.com. Don't wait. Get it right now before prices continue to skyrocket. goldforthefuture.com.
In KCM's view, a potentially less dovish Fed chairman pick and a stronger dollar were key drivers of the decline. At the same time, traders were already jettisoning overheated positions. Gold and silver had become extremely overbought, triggering profit-taking after their historic run. Crucially, this move coincided with a liquidity squeeze. Margin calls and stop-loss cascades forced large leveraged longs to unwind mechanically. Crypto Ticker reported that excessive leverage in futures amplified the crash, citing an $11 million silver long being liquidated and noting that gold also sold off sharply as margin pressure rather than a true loss of safe haven demand. In short, an abrupt shift in risk sentiment, plus forced selling across asset classes, equities and crypto markets were also plunging, ignited the metal's swift fall. Reactions from analysts. Market veterans largely viewed the drop as a technical correction in an otherwise strong uptrend. Many pointed out that both metals remain far above year-start levels, gold still up approximately 18% YTD, silver approximately 40%, despite Friday's fall. Analysts noted that ETF and retail positions had become crowded. For example, some gold and silver ETFs saw record turnover and outflows on the sell-off. Yet even amid the panic, bullish voices prevailed. UBS quickly reaffirmed its bullish outlook, raising its 2026 gold target to $6,200. Prithvi Finmart's Manoj Jain and Indusin's Jigar Trivedi emphasized that the metal's fundamental drivers, geopolitical risks, tight physical markets, and industrial demand remain intact. Jain argued that Thursday's high closes and strong January momentum suggested the drop was mostly profit-taking from record highs. Trivedi pointed out that silver's 9-month winning streak and a surging dollar still support precious metals in the medium term. The consensus advice was to buy the dip, treating Friday's plunge as a liquidations-driven shakeout rather than a change in the bull narrative. Historical context: all-time highs and repricing narrative. Just 1 week before, on January 23rd, gold and silver had hit unprecedented highs: $4,967.48 and $100.29 respectively. That rally was fueled by a perfect storm of factors: de-dollarization by foreign central banks, geopolitical uncertainty, shrinking silver supply, and rampant speculation that Washington might officially revalue its gold reserves. In fact, analysts were openly discussing repricing U.S. Treasury gold from $42.22 to $8,000 per ounce, which would create roughly $2.1 trillion in balance sheet room. Ultra-bullish forecasts abounded. Macro strategist Tom Bradshaw even charted a technical path to $9,000 gold and $375 silver by 2028. Economist Peter Schiff was targeting $6,000 gold in 2026 and $10K, $20K longer term, with silver easily above $100 already. Miles Franklin's Andy Schectman similarly expects an $8,000 plus repricing in the near term, viewing gold accumulation as central banks' top priority. In short, before the flash crash, the market was pricing in possibly epic upside. Even after Friday's correction, current prices remain well below these headline targets, and the $8.9K modal repricing level envisaged by many strategists. Buying opportunity fundamentals intact, history suggests such sudden dips can offer a strategic entry point. For perspective, gold's last crash of comparable magnitude was in April 2013, 9%, after which it regained ground to eventually hit new highs. Silver similarly saw violent one-day drops in late 2025, 8.7% on December 29th, but rebounded as physical demand reasserted itself. Today's sell-off occurred against a backdrop of strong fundamentals. Global demand drivers, from a weakening dollar and central bank accumulation to multi-sector demand, solar panels and electronics use vast amounts of silver, remain in place. Mining supply constraints are acute. 75% of silver comes as a byproduct of base metal mining, so output can't easily ramp up. Meanwhile, analysts note that even with the slide, gold and silver prices are still far higher than a year ago and close to key supports. Structural demand. Emerging market central banks are aggressively diversifying reserves into gold. For example, Goldman Sachs projects central banks will buy approximately 60 tons of gold in 2026. This de-dollarization trend underlies the long-term bull case. Supply tightness. Silver inventories are at multi-decade lows, and futures markets recently went into deep backwardation, signaling immediate shortage. Physical coins and bars are in scarcity, suggesting paper markets may keep tugging on prices higher once volatility eases. Industrial growth. Clean energy and tech applications, like solar and 5G electronics, are sparking record industrial demand for silver. With supplies constrained, this is a durable tailwind. Macro context. U.S. inflation is cooling, and the Fed is widely expected to cut rates later in 2026, lowering the opportunity cost of holding non-yielding metals. Combined with fiscal uncertainty and debt concerns, this supports higher gold prices over time. Given these factors, the January 30th shakeout may be viewed as a discounted entry point for long-term bulls. Gold trading around $5,100, $5,300 is still far below 2026 targets. $6K plus consensus, $8K plus repricing scenarios. Silver near $100 remains well under the $120 plus $150 levels some analysts see on the horizon. As one Indian analyst put it, the fundamental case remains strong, despite the volatility. Outlook. In summary, the flash crash has injected urgent caution, but not altered the broader narrative. Rapid deleveraging events like this can exhaust weak hands and set the stage for the next leg up. Historically, after extreme overbought corrections, precious metals have often resumed their uptrends. With headline long-term scenarios, from the gold revaluation theory to secular safe haven flows, still on the table, investors are watching for a stabilization or rebound as confirmation. In practice, that means tuning into technical support levels. Gold $4,980, $5,220, silver $98, $110, and any shifts in policy or geopolitical risk. Strategically, the crash may offer a rare opportunity to accumulate at lower prices, aligning portfolios ahead of the anticipated upside implied by central bank buying and the gold backstop theory, where the U.S. revalues its reserves.
Welcome to Precious Metals Central. Today, we're looking at our top recommendations for precious metals companies. Birch Gold Group, best overall, offers gold, silver, and other precious metals with a low minimum of only $10,000 for IRAs or cash purchases. Request info at goldforthefuture.com now or find all links below the video. Augusta Precious Metals is the clear winner for higher net worth accounts of $50,000 or above, offering a complete white glove service experience. They have been rated Best Gold IRA several years over by Money Magazine. Get free info kits now. Go to goldinvestingtoday.com or call them now at 1-855-470-4636. For a limited time, get 10 years of no fees. Don't miss out. Noble Gold Investments is the best choice for bullion. Minimum investment is $20,000, and they feature reliable storage in Texas. Request more information now by going to noblegoldinfo.com. You can see more options on the complete list of recommended companies by going to preciousmetalscentral.com. Thanks for watching.
When your dollars feel tired and your savings seem small, turn to treasures that glitter, where the value stands tall. Gold, silver, everything shiny. Stack it smart, make a long-term plan. PreciousMetalsCentral.com preserves your buying power like paper never can.
Welcome to the new era.
When the prices start climbing and the headlines all wave, you'll be calm, sitting pretty